Hello and welcome. My name is Jonathan Stav, and here at Sectors Made Simple, we have over 100 hours of educational content and investment resources to help you have the knowledge and tools you need to invest simpler. Today, I want to teach you about the basics of bonds. Bonds are a rarely thought about type of investment that can offer a really good way of offsetting risk in your investment portfolio. And today, we'll cover all of the basics of what you need to know about bonds to go into any decision you make more informed. So, let's take a look at what we'll be covering in today's webinar. In today's class, we'll cover what a bond is, how bonds provide returns, what the different grading systems for bonds are, the main types of bonds, and the pros and cons of bonds compared to stocks and other more traditional types of securities. Let's get started with the basics of what bonds are. In very simple terms, a bond is an IOU. The issuer, or the person that writes the bond, provides the bond to whoever is giving them money. And in exchange for that money, the bond includes a lot of details about when they're going to pay it back and how they will pay it back. Most bonds include what is called an interest rate, or these little payments that they'll provide whoever's holding that bond as a reminder of, hey, we still owe you this money, but in the meantime, and as a thank you for letting us borrow your money, here's a little bit of interest. If a bond pays interest, they will also include the rate for that interest, as well as how often that interest is paid. Finally, bonds will have a maturity date, or the date at which the company or issuer will need to pay back the full amount of that bond. But again, let's focus on the parts of bonds that actually matter to us, which is, how do they make us money as investors? The main way is through those interest payments that we mentioned before. Every bond that offers interest will include the interest rate, which is often shown as an annual rate, and how many times per year that interest is applied. So for example, if we have a $100 bond that pays 5% interest annually in semi-annual payments, what that means is that we will receive 2 payments a year, one every 6 months, to the tune of 2.5%, or for an $100 bond, $2.50, and we will receive those payments until the bond reaches its maturity. Speaking of maturity, when that bond actually reaches the end of its life, you will receive the full value of that bond back. So for that $100 bond, that means that you will receive $100 when that bond reaches its maturity. But what actually determines what interest rate a bond will have? Well, funny enough, it's not very different than how an interest rate would work for consumers, like people like you and me. It's a factor of 2 things. Time. How long is that bond going to be for? How long are you going to hold my money, essentially? And the second part is risk. Just like we have credit scores, companies will have credit scores based on how likely they are to be able to repay their bonds in full and not default on their bonds. Because of this, companies that have a higher rating or better credit score will have a slightly lower interest rate because there's less risk of them not paying back that bond amount, compared to companies that have less than great credit, which will offer a higher interest rate as a compensation for that increased risk in defaulting. Now, when we're talking about credit rating, while consumers have the 3 big credit bureaus that we're all probably familiar with, there are 3 major bureaus that keep track of company bond ratings and their credit score. These companies, again, they're not the only ones, but these are considered to be the big 3, are Standard & Poor's, Moody's, and Fitch. Now, all 3 of these have different grading systems, and we're not going to go into the details of what all those grading systems are, but what we should think about is that there are 2 main groups of bonds. Investment grade bonds, which are considered to be, as the name implies, investment grade. Fairly low risk, and as a result will have slightly lower interest rates. Now, the tier below that is going to be junk bonds. Bonds that have a fairly high risk of defaulting, and as a result will pay significantly higher interest rates in return. Now, when it comes to bonds, there are 2 main families of bonds that we can talk about. corporate bonds, which are bonds issued by companies, and municipal bonds, which are bonds that are issued by local governments, states, or even the federal government and the Federal Reserve. Before we get into defining all of these and talking about their similarities and differences, there are a few odd cases of bonds that I want us to talk about first, because they will apply to a few of these different types of municipal bonds. So, here are a couple odd features of bonds that you should be aware of. The most common type of odd bond that you might run into is going to be those zero coupon bonds that we briefly talked about before. These are bonds that offer no interest or zero coupon rate, and instead, profit is made between what the bond is initially sold for and what the face value of that bond is. So you might be able to buy a $100 face value bond for somewhere between $50 to $60, depending once again on that credit rating and how long the life of that bond actually is. The next three are going to be much less common, but will still happen and you should be aware of them. The first is going to be convertible bonds. These are not going to be a fancy kind of car, and instead are going to be company or corporate bonds that can be exchanged for shares in that company. The second type is going to be callable bonds. Callable bonds are bonds that can be called back or essentially paid off by the company before the maturity date of that bond is reached. The final type is, funny enough, the opposite of the callable bonds, being puttable bonds. Puttable bonds allow the bond holder, whoever is currently holding that bond, to sell it back to the company early in exchange for the face value of that bond. Now that we've talked about many of the odd bond types that you might run into, let's start getting into the details about corporate and municipal bonds, starting off with the easy one, corporate. Corporate bonds are, again, these financial IOUs that can be issued by private or public companies and sold to investors. The next type for us to talk about are municipal bonds. But while we grouped in federal and municipal bonds before, now we're going to separate them a little bit, where municipal bonds are going to refer to bonds that are issued by local, state, or other government organizations. These bonds offer some unique advantages in that they are often tax exempt. They offer no liability for taxes on the federal level, and if you live in that city or state, you can also be tax exempt for the bonds if you buy bonds for that local government as well. These bonds can often be purchased directly through your broker, so if you're interested in those, contact your broker to see what options or availability they have to invest in local municipal bonds. Before we get into federal securities, I do want to mention that we really would appreciate a like and a subscription. Likes and subscriptions are entirely free and are a great way for you to invest in your own financial education. Likes really do help us to understand what kind of content you're enjoying and what we should create more of in the future. The final type of bond for us to talk about are those federal bonds, which are probably the most commonly bought and sold type of bond for the average investor. And while we say Treasury bond, it's important to remember that while bonds is this big group of securities we're talking about, Treasury bonds refers to one specific type of debt security, 30-year bonds. For anything shorter, we have some different names for those types of bonds and debt securities that we can go over. So, let's take a look at the different types that we have. There are many different types of debt securities that the Treasury Department issues, so let's start off with the shortest term and work our way up from there, starting with Treasury bills. Treasury bills, or T-bills as they're often called, are zero coupon bonds that have a maturity date of less than 1 year. Above that, we have Treasury notes, or T-notes, that have maturity dates between 2 and 10 years, and then finally, Treasury bonds, having 30-year maturity dates. Finally, there are two special types of Treasury securities that I want us to talk about. The first is going to be what are called TIPS, or Treasury Inflation Protected Securities. These are bonds that range from 5 to 30-year maturity and offer something that many bonds don't: interest rates that change based on the current rate of inflation. where they will offer you an interest rate that tries to help offset periods of very high inflation, giving you a way of minimizing your risk if inflation is very high, as it's been over 2021 and 2022. The final type for us to talk about are what are called FRNs, or floating rate notes. These are 2-year debt securities that offer a quarterly interest payment that changes rates over time. All of these bonds that we've talked about can be bought through the Treasury Department at treasurydirect.gov. Finally, let's take a look at some of the pros and cons that bonds offer to us when we're comparing them against more traditional types of investments such as stocks. Some of the pros include: the most obvious benefit is going to be predictable returns. Bonds will either be zero coupon, at which point you know exactly how much profit you will make, or those interest rates are very well understood, meaning that you can know exactly how much profit you will make and how much those returns will be over time. On a similar topic, bonds also provide investors a type of security that is very well understood in how much risk you are getting yourself into. Compared to something like stocks, where risk is really up to the person, bond ratings provide us a very tangible way to understand risk versus reward. Another benefit is one that we mentioned when we were talking about municipal bonds, being that many of these bonds and other securities offer tax advantages, being entirely tax exempt in many cases, providing us with a way of offsetting our investment returns with our taxable capital gains. The final benefit is that unlike stocks, where we have to worry about when do you buy in and when do you sell, bonds are much more simple in that we can understand when returns are made, and we don't have to be worrying about, is now a good time to buy in, or should I wait for a different price to happen? Now that we've talked about all of the reasons that bonds are a great choice for investors, let's talk about some of the less positive things that we should be aware of. The first one is that bonds always carry a risk of default, or the company or issuer failing to provide the full payment of that bond in return. Now, while this does seem like a crazy idea, it does happen, as we've seen it happen in the past with major corporations such as the Evergrande real estate company from China. Another downside is that bond returns are fixed, except for very unique cases like tips. How much interest a bond pays out doesn't change over time, meaning that if inflation rises and outpaces the returns of that bond, you could actually be losing money because the amount of those interest payments isn't enough to keep up with the rate of inflation. The final downside to bonds is the fact that bond markets tend to be significantly smaller than that of stock markets. While there is a very large and very popular market for buying and selling stocks, bonds tend to be a little bit less traded, and as a result, if you want to sell out of a bond early, it can be difficult or even impossible to find a buyer to pick up that bond from you. Before we get into our summary, there is one little thing that I want to mention. If the world of bonds is a little intimidating to you, and you want to just stick with the more traditional brokerage account with securities that you can buy and sell on major stock exchanges, it doesn't mean that you can't gain exposure to bonds. There are many ETFs that trade strictly bonds and other debt securities that will give you access to those unique asset classes without the hassle and worry of having to deal with things outside of what's traded on a public exchange. We've covered a lot of information today, so to help us remember it all, let's take a look at everything that we've talked about. First, we talked about that bonds are a diverse type of investment that is issued by companies, cities, states, and even the US Treasury Department. These bonds are financial IOUs, in which the issuing entity is lent money on the condition of paying it back in the future. These bonds offer us a valuable alternative to stocks and have their own unique advantages and disadvantages. The biggest benefit is that the main way that bonds provide us returns is through predictable and measurable interest payments. Additionally, because bonds are rated by credit bureaus such as Fitch, Moody's, and Standard & Poor's, it is very easy for investors to know how much risk a specific bond carries with it. The biggest drawback to bonds is that most bond rates don't change, which means if inflation is high and inflation outpaces your bond's returns, you could end up losing actual money because of the difference between inflation and the bond yields. So thank you all so much for joining us for today. I hope you found this information about bonds useful, and we hope to see you back here at Sectors Made Simple to continue make investing simpler for you in the future.